Hi everyone. Welcome to our webinar today on a Sunday morning. And the topic for today is unlocking the power of AI for smarter investing. I have with me Mr. Karthik. Karthik is the founder of Quantace Research. He has more than 12 years of experience in the Indian stock market. And before starting his own research desk, for 5 years, he has worked with Motilal Oswal as a quantitative analyst. Karthik, happy to have you today with us. The format of the webinar will be such in which for the first 30 minutes, Karthik will share his insights about stock market, investing, AI models with you. And then we'll open up the floor for our audience where you can ask live questions to Karthik and we'll be happy to address them. So without any further ado, I would like to start the webinar. So Karthik, the markets have corrected from 19,800 levels, the Nifty 50 index to 18,800, and then on Friday has given a bounce back. So what is your view on the markets? How should a retail investor handle such kind of volatility?
Right. So currently Nifty is at 1900 levels, and if you, I mean, from a fundamental perspective, if you look at it, the earnings are at about like 905 rupees. So let's safely assume it to be like say 900 rupees, and at current 1900 levels, right? If you look at say trailing 12-month P, like it is about like say about 21. So let me just share my screen to show. It's like- yeah, let me just start with the disclosure first. Investments in securities market is subject to risk, and so we are a SEBI registered RA, and this is our registration number. And stocks and illustrations, whatever we present today, is for educational purpose, and it should not be taken as an investment recommendation from our end. I was talking about this thing. So if you look at say Nifty PE, so currently like it is at 21. This year we have taken average for September. I mean October it is about 21. If you look at it, like when was it last available at such levels? Probably back in say March, April, where this Nifty went up from April, or like say even July, where it was available at 20 PE. And if you look at say Nifty's projected earnings for say next year, like it is around 20%, like which is what the brokerages are predicting. But let's again be pessimistic here and like assume a 10% rise in earnings, like which will make the earnings like very close to like say about 1,000. So at forward PE, I mean, when was it like available at such levels? Usually like it was at like say July and way back in 2016. And India happens to be like one of the fastest growing economies. And so, I mean, these levels, right, is very hard to get for say a economy like India. I believe that like say going forward, we might see Nifty very close to like say 21,500. Why? Because there are other aspects also apart from earnings. So if you look at Nifty's last 2 years returns, right, absolute returns, so without say dividends, etc., it's about like say 2-3%. And typically over a 3 year time frame, right, Nifty gives you about like say 43-44% kind of returns. Whereas if you look at the absolute loss, like it's in single digit number, say about like say 5-6%. So which kind of makes it favorable to start building positions in say Nifty, at least with a say a longer term view, like say at least a year or so, and that should work out well for you.
So to summarize, Nifty is not at a very overstretched valuation like it has initially been in, and 21 forwards earning ratio seems like a stable level where you can start building your portfolio again for a 1 to 2 year kind of a horizon.
Yeah, and I forgot to add about the pre-election rally, which usually happens like right since like say 1999. That is also one of the factors like which we'll have to consider where government spending is going to increase. So which will automatically get reflected in say stock markets. So if the government increases its spending, so this is also one of the factor which we'll have to keep it on back of our mind.
Correct. In the previous kind of elections, we have seen that before the election happens, there's always a rally in the stock market in anticipation of a government, either a new one or the existing government coming in power. So that is definitely one factor that we should keep our eye on. And now we'll deep dive into our topic, which is AI-based investing. So, Karthik, please help us understand in simple terms how a retail investor like me and many of other viewers who are right now joined with us, how can they leverage AI and what is AI-based investing?
Okay, so let me start with a simple thing. So a lot of people think like cons and AI is like very complex. So whereas like I would say that like it is simple common sense like mixed with data analysis. So based on few mathematical models, statistical models, so that like you end up making the right decision most of the time. So let me just start with a simple example. Like so today, right? Like sorry. Yeah. So today, if you look at it, right, like we have a lot of compute power available. So and so with the amount of compute power available, like we can analyze large and vast amounts of data, which a human being will find it difficult. Why? That's because like let's take a very simple problem like how many ways are there to like structure a say 10 stock basket from Nifty 50 names. Like just take a simple guess. Like so there are about 10.27 billion ways. And let's assume like humans are efficient and like they get to spend like 1 second for every possible combination. And even if they are able to do it, like it will take them very close to like 325 calendar years just to like I mean, go through all the combination, forget the analysis part. So this kind of compute, right, like is not available for say normal person out there, like which is very difficult for them to do it. So that is where like all these AI ML methods come in. So and today, like if you look at your say a typical say a PC or a laptop which you are working on, so the compute power available on that PC or a laptop is equivalent to a say supercomputer way back in say 1960s type. So that is the kind of technological advances like which we made in this field. And if you look at it, like most people feel that like for being good in investing, right? Like it just takes skills. Like read some books, like build some skills, and then you're sorted. Like you'll be a great investor, etc. But in reality, like there is an element of luck which I would say is an element of probability. So, so this is how we look at an investment problem. Like it is both skill plus an element of probability. And when I say skill, like these are we build on the skills like using quantitative methods, statistical methods, mathematical models, etc. And the probability part is where like we use it for say risk management purpose. So cause risk management is very crucial as far as quant investing is concerned, because like if something goes wrong, like you should be well equipped to know like what is the kind of drawdowns like which your particular basket might show. And this is where like we come in and like we use both AI and data science to create that quantitative edge, like so that like you'll have both uh, exposure to both say skills and say probability, so that you'll be able to win going forward. And let me just show an example, like how you can say control the probability out there. So for example, let's just take a coin toss. A coin toss is very simple, right? When you toss a coin, like it is either head or a tail. So but like for you to game the system and like say like look for a pattern, so what you look for is a pattern. Like in this problem out there, we are looking for a particular pattern, two consecutive heads or tails, be it this or this. And here we are saying that
Karthik,
the
sorry to
subsequent.
interrupt you.
Yeah,
Karthik, are you sharing your Excel?
yeah, I'm sharing my Excel.
No, no, we are on the
Okay,
PowerPoint presentation.
1 minute. Let me just let me.
Yeah, it's visible now.
Yeah, it's visible now, right? Like, so going back to coin toss, like here, I mean, we are hunting for patterns in coin toss problem. So we are looking for either two consecutive heads or two consecutive tails, and taking a view that the subsequent toss might either be tails, like in case of say two consecutive heads, or vice versa. So here we are just simulating 1,000 random scenarios, like where I mean, depending on like your system, like it keeps generating such scenarios. So, and if you look at it, like we are taking a bet that like whenever we lose, like we'll lose 100 rupees, and whenever we win, like we make 120 rupees. And if you look at it, there were about like say 495 times like such patterns were satisfied, and out of it like say only 251 times like it was favorable, which is approximately 50%, whereas rest of the time it was not favorable, right? Like, so you have a worse system here, like where you have only like 50% probability of winning, but still like most of the time, right, like you keep winning. Why? That is because of this factor, like which is risk to reward. So whenever you're winning, you're making 120, and whenever you're losing, you're losing 100. And so when I reduce this, say, risk to reward to say even zero point 0.8, so no matter what you do, right, like you'll end up losing. So as a quant, right, like we always are very finicky about like our risk levels, and we try to make sure that like we are in the range of say 1.2, 1.3, so that like I mean, even if we go right, go wrong, like I mean, we won't have much of a hit. And whereas, like, if you look at, say, typical system, right, like, say, any benchmark index as, say, sharp ratio of zero point 0.5, like, so if you look at zero point 0.5 risk to reward, so you need a minimum of, say, 70% out there to, like, just be in green. So even if you say like win 65% of the times, like which is two on three times, like you end up losing just on that one element of probability. So because I mean there is a lot of randomness out there. So you'll have to take into account an element of probability also, like while you're constructing baskets. And this is what like we kind of do at Quantace, like where both it is about skill and probability, which I'll call it risk management, so that like you always know like what is your say downside levels, which you can comfortably refer to.
Understood. So when you're talking about downside risk or risk protection, for example, there is a stock in your portfolio which is not moving as per the direction it was supposed to, and there's a drawdown. So how does the AI model determine that this is a time to exit a stock?
So we follow rebalances, like so, like I told you, right? Like we create algorithms, so where we code our own set of say models, and like we run it like every week or every month. and the system decides as to like whether to have exposure to a certain stock or not. Just to give you an example, like when the Adani fiasco happened, like we didn't have exposure to these stocks in any of our baskets. In fact, in our momentum basket out there, like we had exposure to only like one of the Adani stock, in fact, like Adani Enterprise, and still like we ended up being positive for that day. Like so that's because like since like we look at say reward to risk perspective, like we are able to like weed out risk very fast from our baskets than say a traditional manager.
Correct. So basically, it is able to predict based on the data that is available in the market that, okay, Adani is seeing some kind of selling pressure or the stocks might be correcting in the future.
Yeah, so we use daily data available, so which is uploaded by the exchanges. So like you tend to capture those patterns from this data and then make some kind of prediction saying that I mean this is something like which you'll have to be careful about.
Correct. And now that we are talking about risk, I'd like to ask you a question that we are seeing a war-like situation in the Israel region. So does the AI model consider such kind of risk?
Okay, this is again a wonderful question because I would say that I would easily say like these are black swan events. Like again, like I have a say mm, something to share here. Like if you look at it, like this is I took it from this gentleman, like Nassim Nicholas Taleb. So he explained this in his book Fooled by Randomness. So where he explains the concept of black swan. So this is inspired from him. So if you look at Turkey, right? I mean it has a certain belief that like humans take best care of it for whatever reasons. So and it is being fed properly and then being taken care of, like say about like say 6 to 8 months into Thanksgiving day. But on the evening of Thanksgiving, right, like something strange happens. This is what happens to the turkey, and it will incur a revision of belief. So I would say that like humans by nature are also like exposed to such black swan events, like which are extreme volatile events. Like, did it happen in past? Yes, like this happened in past. Will it happen in future? Yes, it will happen in future. Can you predict it? No, I would say that like you cannot predict it. But can you control it? Yes, you can control it through your risk management practices. So the way we say construct our baskets is such that like we construct in a way that like even if there is a very adverse event out there, like your basket should not see much of a volatility. And one of the methods like which we use is like this, which I call it, this is called Monte Carlo or a historical simulation. So if you look at it, like this is actually one of our baskets. I won't say which basket it is. Like, and we kind of simulate random paths as to like what is the best expected returns in say 6 months, 12 months, or like say 3 months time frame. So this is a risk part, and this is my black swan event. Like this worst line which you see, right? This is my black swan event, and this is my like say median or average returns that I can expect from the basket. So when you build models like which can I mean say you like what is the worst possible like say number which you can see or expect, like you know that like this is the one like you can expect on a black swan event. So in fact, like whenever this happened right in the past, like I remember like when Ukraine war happened, like that was the first black swan event like which I saw for Quantace Research. And like all our baskets did better than the benchmark. And that's because like we kind of build such kind of simulations into our baskets so that like you don't see much of a risk like when such events happen.
Perfect, Karthik. And now that we are talking about such kind of black swan events, I understand you have a portfolio on the defense sector. So with such kind of war situations in Russia, Ukraine, Israel, Hamas. So, what is your take on the defense sector? Do we see any kind of growth in defense, or what is your take on this theme?
So defense as a theme, right? We like it. That's because like if you look at it, India happens to be in a neighborhood where like you have two neighbors who are not so friendly, and like they
Correct,
keep challenging your territories like every day. So for us to like say I mean say to nullify the say two front war, like which is what uh, people generally term it as so we need to like say build up our own defense capabilities. The only way that is possible is through expenditure on military spending, and we also have like say schemes like say Atmanirbhar, like PLI schemes, like where it is more of a say self reliance, like which is what we are talking about. So the thing is, right, and one more thing, today, India is fifth largest economy, and by 2030, like it is projected to be a third largest economy. So for
correct,
economy like us, like it is very important to protect our trade routes. So be it like say imports or exports, imports being like our energy needs from Middle East, or like or exports like to other countries, like be it like through Chabar port, or like say through Middle East corridor, etc. So I mean, we need to protect our trade routes. And if you look at it, like again, China is kind of threatening our hegemony in Indian Ocean region. So in fact, if you have been following the news, I mean, in Maldives, I mean, say China pro kind of president is expected to take power, and one of the things like which he is very keen on is like say demilitarizing. I mean, asking the Indian forces to like kind of leave the Maldives region. So for us, right, like it is becomes like very imperative, like to like say, I mean, protect our trade routes again. And so only way like which we can do it is through investing in our own self-reliance capabilities, and like say shipbuilding, etc. So also like if you look at shipbuilding stocks, right? I mean, I yeah. If you look at L&T or Macedon Docks, both of them signed agreements with like say U.S. Navy for I mean allowing their ships to like say repair. I mean uh, to port at our docks and like carry out repairs. So there are a lot of factors out there which kind of I mean makes it favorable to take a say 5 to 6 year kind of a view. Because like if you're looking for a say very short term view, like and say that okay it looks like overvalued, overstressed, etc. Yes, like obviously it looks overvalued like if you take a very short term view. So, but if you play a say 6 to 7 year kind of a theme, so this will eventually get, I mean, uh, turn out to be a very good theme to play. So, and this is what our belief is over say 6 7 years, this is a theme like which is going to kind of pick up steam. But things to watch out is like obviously like say orders and execution capabilities so one is that order inflow has to happen, and second is like obviously execution. So I mean
correct.
these projects usually have longer gestation periods, so you'll have to keep an eye on execution speed, I mean execution capabilities of these companies too.
Correct. So to summarize, defense is a long-term theme. Either if you are entering this theme right now, where the valuations have increased, you should be there for at least 5 to 6 year horizon.
Yeah, this is what our belief is if you have a short term view, like it will be very difficult for you to like say I mean cling on to this thing.
Correct. And the companies should not only receive orders, but they should be able to execute and actually turn it into cash flow for these companies where they are getting payments for the orders that they've received.
Exactly.
So, if a retail investor wants to take an exposure to a defense theme, what percentage of portfolio should he allocate to such kind of a specific theme?
Okay, not only defense theme, like if you take any thematic basket, right? As an investor, you're exposed to thematic risk. So, which is what you'll have to control. So, I mean, I believe that like if you have a say 1 crore ticket size, then you should uh, you should probably like restrict it to 5 to 6% for any theme out there, because you typically do not want to take a lot of thematic risk, because all these stocks by nature react in a particular way, and if it
Correct.
happens to be a negative way, like it is going to adversely impact you.
Correct. So basically, don't take a very large exposure on just one theme. It will add a lot of risk to your portfolio. So rather keep it like capped at 5 to 6%, so that even if in case of any drawdowns, you're protected from it.
Exactly.
So defense and manufacturing go hand in hand. So like, what is your take on the manufacturing sector, or it does defense cover most parts of it?
We do have a manufacturing team out there, but my take on manufacturing is that like it is China plus one, story which is getting played out. So world increasingly is getting, I mean, not convenient about China controlling the entire supply chain, and they want to like say de-risk or like say diversify their bets out there, and that is where countries like India, Mexico, like Vietnam come in, and it gives an opportunity. And why like it is a better opportunity for India is like because like we have a access to like large skilled labor so I mean, you cannot find such kind of labor at a very affordable cost, right? So this is one prime advantage which we have as a country out there, and this combined with like say schemes like say for PLI and then like single window clearance. So all these kind of make it more favorable. In fact, like if you see 2 3 years back, India hardly used to manufacture, say, mobile phones. Today,
Correct.
you have reached a stage where Tata is going to manufacture iPhone. Probably like a
Correct.
year from now, like when they complete the takeover, etc. So when such things happen, right, like an ecosystem gets built in. So along with say for example, for mobile phone, I come from a city called Chennai. So I know like when Hyundai came in, right, how the face of the city like changed completely like after their entry, then when they entered, like a lot of say new multinational companies, large multinational companies came in, and that ensured that you create an ecosystem for say auto component parts. So and in fact after Hyundai came in, there has been an explosion, and at least in Chennai, for say like small units which is into which are OEM suppliers for these auto companies. So such benefits will eventually trickle down into the system. And we believe that given our advantages out there, so this should pan out well for us.
Correct. So I think like Tata is now planning to manufacture iPhone in India. So it sets a precedent for even other companies, other major brands to come and manufacture in India. So I don't think so. The day is that far away when even Tesla will start manufacturing cars out of the plants in Chennai or the plants in Pune's Chakan area.
Yeah, and one more thing is that if you look at government also, right, they have been very smart, because we have access to large consumer base out there. So and they have put import duties on say electronic components, which force all these tech giants to set up local factories in India, which in fact kind of further strengthens our case, like having skilled labor, then large consumer market. So and all these policies out there which the government is formulating, so all these are going to kind of work in our favor as far as manufacturing theme is concerned.
So I had one question. Like there is a news that Tata is going to manufacture iPhone in India, or someday. might be coming to India to manufacture. Can such kind of news events be built into the AI models that you have?
Unfortunately not, but I mean, AI models are kind of, I mean, working on these two. So there is something called as sentiment analysis. So where I mean, a lot of AI models are structured in such a way that like it will pick up news faster than rest of the market and like take positions. So such things are there. But if you look at the future of AI, right, so I believe it is going to say further strengthen itself, because like if you look at say India at least, I mean with the say like rollout of 5G. So one thing like which
Correct,
I'm very keen on is like say IoTs. So Internet of Things. So where you'll have real time information to like all these alternative data. So this is something like which is growing off late, like apart from traditional say price and fundamentals out there, right? Like access to quality alternative data sets. And for example, like let me talk about like say computer vision. So there are hedge funds in US which kind of I mean looks at satellite images of how many cars are parked out of Walmart. So
correct,
the reason being that Walmart usually, I mean, it is structured in such a position that like it is outside the city. Like everyone takes their like pickup trucks to Walmart and they shop for entire week or two, and then like
correct.
they kind of predict what is the probable sales like a particular outlet is experienced to see. Or for example, like even if you have IoTs, right, like for example, like if you keep it outside say like at entry of a DMart, so you'll know like how many people are walking in, and like like what is their average order value. Like you come to say best estimates as to like this is the kind of sales like which we can see. Like, and this is where I believe AI will eventually move to, like where I mean technologies out there like say IoT 5G, like this is going to like kind of help in like building this alternative data sets and then make a better forecast models as far as sales is concerned.
So, like today, whenever news analysts predict that, for example, DMart is going to have 2,000 crores of sale, with the help of AI and technology, we'll be able to predict it to the nearest number possible. That what is the figures that this company is going to report even before the quarterly results. Is that right?
Yeah, ultimately, we are slowly moving to that fashion only. Like, in fact, like if you look at world's largest asset manager, say BlackRock, they
Mhm.
manage $20 trillion of asset, like, and through their Aladdin framework, like this is all
Correct.
like AI driven. So, like you without knowing all this, right, like this is already happening. So eventually like this will happen someday or the other, like maybe like 5 years, 10 years. But I expect this, the pace with which like this will happen will be like very brutal, and like it will be very fast, this is what my personal opinion is.
So, how can people like retail people benefit from such kind of innovations that are happening in AI, take benefit of it, and leverage it to have a more balanced portfolio in which they are reducing their drawdown risk?
That is where account firms like us come into play, right? The reason why we established like Quantace Research is that we wanted to give retail people the access to same kind of say sophisticated strategies like which say HNIs or institutions use. And so we are slowly building our own capabilities. So right now, like what we are offering is bare basic, but whatever I've talked, right? Say computer vision, etc. Like this is what like we'll be focusing on in years to come. Like maybe like over next 6 7 years is what we are looking to build in. So capabilities on alternative data sets, etc.
So the best method possible for retail investors is either basically take a paid advisory from a quant based firm and based on their recommendation, trade on their portfolio.
Yeah, because we offer it at the best price possible. So even today, we are affordable. So
Correct.
technology makes say tech more accessible and affordable. And this is what we are focusing on. And since we don't have any kind of a human bias, we would say that we are more scientific and data driven, and we are able to eliminate, combine this with the risk management practices. We are able to eliminate the most common mistakes, which kind of happens in investing.
So, can you just throw some light? Like, what kind of mistakes are happen when a human is taking a decision rather than when an AI is taking a decision?
So okay, I think okay, I have an example to show. Let me just
Sure,
show
please.
you. So for example, right, I think I didn't show this slide out there. One. Yeah, okay. I'll start with this. If you look at it, right, this is an image of a well-balanced Maharashtrian meal. So it has pova in it, and it has, say, bakri in it. So pova and bakri, are essential macronutrients. It gives you carbohydrates. This along with chickpeas, which you call it chenna in Hindi, gives you proteins. So you need a balanced diet, right? And along with this, soul kadhi gives you fats, essential fats, and everything. So you need a balanced diet. You shouldn't have, say, overexposure to any of the nutrients out there. Likewise, right? It is very essential while creating a basket to not have overexposure to certain sectors, stocks, etc. Why? If you look at it, I just have a banking stocks example out here. So if you look at it, typically, most of the people will look at this correlation matrix and decide on what kind of stocks to pick. Most of the cons also in fact look at such matrix only. But the thing is, right, uh, if you enhance it further and you depend on advanced machine learning algorithms, say clustering, for example, so something interesting is happening here. And we didn't feed any fundamental data into this. So it has created four clusters out there. One is Kotak Bank as a separate cluster, and it has clustered all three, say all three PSU banks, PNB, Bank of Baroda, SBI, and then say three private banks here, and then IndusInd and Federal Bank, so together. And it doesn't know that these are PSU banks. This doesn't know that these are private banks, etc. But the thing is, right, apart from just all this, you shouldn't have exposure to similar stocks out there. So the thing, my notion here is that why will you have why will you buy two similar pencils when both are going to give you the same benefits? So you'll either complement a pencil with a pen or a sketch pen, right? Rather than buying a pencil again. So the same principle goes into your say basket construction also. So for example, today we have exposure to say Axis Bank with from one of the clusters here, and then in this cluster we picked up PNB and Bank Baroda, and then we have exposure to say uh IndusInd, if I'm right, and one other one was IDFC. Let me just check it. In fact, this is our actual exposure which we have. Yeah, so if you look at it, we have exposure to two public banks out here and three private banks, IndusInd, IDFC, and Axis. So how is that our system is able to pick up such combinations? And if you look at, say, the Bank Nifty returns for last 2 years since the launch, it is about 16%, whereas we have returned about 32%, which is almost twice what the banking index benchmark index has returned. That is because, right, we are masters in finding these complementary stocks, which I just showed you here. And
Correct.
we have mastered this art, and we look for stocks which are non-similar, which is going to give better stability to your basket, and hence we are able to generate better returns. And even if you look at Friday, right, like out of five stocks which we had, like PNB, Bank Baroda, and then like apart from SBI, we had exposure to uh, five out of top six. And I mean, this is purely system driven. Like I didn't put any human bias into the system. So, and when you remove human bias, right, that is when it is going to create a better, say, models for you. And it all depends on the way you generate these algorithms. And in fact, like I would go ahead and show one more thing here. Like if you see, like this is the current, I mean, way the banking stocks cluster looks like. But if you look at it, say,
Karthik, I had just one
um,
small question, okay, Karthik?
yeah,
Why is Kotak Bank shown separately and away from all these clusters? Can you throw some
yeah,
light if possible?
yeah, I'll explain. Because like if you look at the same cluster, like say 1.5 year back, so Kotak and HDFC is together. Because
Correct.
like if you look at Kotak and HDFC, right, these are like large banks, like which I mean asset quality, like top-notch asset quality, etc. Like which is kind of reflective in the management practices also, right? Like the higher the height is, right, the better. I mean, the more dissimilar it is. But if you look at it, like HDFC moved from this cluster to this cluster. Why? There is a reason, like HDFC Bank merger. That is the reason out there. Like that is the reason. Like today, this cluster looks like this. Like where HDFC is with Axis, ICICI, and I mean, my opinion is that like if you want to take exposure to one of the banks, right? So from this cluster, you'll have to have one or two max, not more than that. Like so that like again you are having access to say like non-similar stocks, which is going to reduce the overall volatility in your basket. And this is what like a machine learning will give you an advantage of, like say I mean over a traditional system. Because today most of the managers like are afraid of removing HDFC Bank from their portfolios. That's because they say that we won't be able to mimic, say, benchmark returns. But we were comfortable removing it, and like that is one of the reasons why, I mean, we were able to say return give a 32% return, whereas the
Correct.
benchmark was about 16% only in the same time
Correct.
frame.
Because even I have seen HDFC banks being in one of like top holdings in most of the mutual funds, and funds haven't been able to remove it from their top holding. And the stock has been in sideways or consolidation phase since the merger was announced. So Karthik, I had one more question. Okay, I got it how you analyze the stocks and how you have created the PSU and banking focused small case. But how do you identify a sector with AI? That this is a sector which has some benefit or growth in it. Like if you could throw some light on that.
So again, right, what we look at is like say overall basket stability. So for example, most of the people mix a stock like say Tata Motors with ICICI Bank, which is very volatile in my opinion. Because if you look at it again in terms of rolling returns, I mean, though like it gives you better average returns, in terms of winning percentage, right, it is around 71-72%. But when you mix the same ICICI Bank with say a stock like say Maruti, I mean, your winning percentage over say any 1 year rolling window increases to 81-82%, which brings stability into the system. We as cons are like very conservative. I mean, we are very finicky about like taking risk, and we want to preserve the capital. This is what our
Correct.
motto is like, and we are okay like sacrificing 2-3% on the upside. So but if you look at it, right, like though like it is 81-82%, like the average returns expected is lower than say ICICI Bank and Tata Motors combination. So likewise, right? We pick up complementary stocks from different sectors, and we have kind of mastered the art of picking these complementary stocks. So which is going to kind of reflect in the kind of baskets like which we create, and hence so it is completely system driven. So there are models where we take say sectorial views. Like if you ask my opinion, we do have say Quantace 5 trillion titans, or 5 trillion India. So where I would say it is a multi-sector, multi-thematic basket. This is the only basket where we are taking a view on certain sectors. And in that, in my opinion, we are positive on financial stocks, then autos, then PSU banks, and even PSU stocks. So these are the stocks like which we currently have exposure to in that basket. So and again, we look at it from a reward to risk perspective. So if any stock or any sector is adding excess risk into the system, we are happy removing it, because we are risk averse, and we would like to be risk averse going forward too.
So, Karthik, if any investor is taking exposure to your small case, like what kind of risk exposure should he have? Like what kind of drawdown capacity should he have? Should he be able to digest?
Okay, again, I will go back to stats only to answer this question. So, if you look at it, right, um, so this is that ICICI and Tara, ICICI and Maruti example out there. But if you look at it, so see, we are dealing with randomness out there. So whenever people ask me is it the right time to invest? Like what is the drawdowns like which I can expect, etc. So and okay, let me first come with introduce the philosophy which we have. So these are the four fundamental principles which is kind of reflective in nature in our methods. So one is that we don't leverage. So we would ideally say do not borrow and invest, and do not waste your time trying to timing the market. Rather spend time in the market, that is going to help you. And we are firm believers of AI and ML, that is going to eliminate human bias. And fourth is the most crucial thing. I mean, know the risk before investing. You should know the risk, because most investors, right, they don't know what is the downside risk which they can expect. So this is something I would suggest that every investor should know, be it anything like a fund, I mean, say sectorial risk, thematic risk, or say drawdowns, etc. Know it before you invest. And this is where say rolling returns come into play. If you look at it, uh, say in any
Karthik,
six
sorry to
months.
stop you there. Karthik, just
Yeah.
can you, for investors' information, explain in brief what is a rolling return and how is it different from absolute return?
Okay, most of the people, right, they just look at absolute returns. For say, for example, today, they look at what is the returns of the benchmark over the last year or so. So, and then take a decision. But and it is just a number, right? What is that you can expect? So, why can't you say change the problem altogether, say, and you take 1 year rolling return right from say 2006, year, we have taken it right since 2006. What year we are trying to say is that instead of just looking at say a single number, look at point to point returns over a time frame, and take a window, and then slightly move it with every month, every day, etc., depending on how comfortable you are, and then take an average or median of it, so that you will know what is the expected returns in any rolling window time frame. So, and if you look at it, we look at it from two perspectives. One is the what is the average returns, and what is the winning percentage. And if you look at a benchmark index like Nifty, right, so in any 6 months rolling window, on an average, it gives you 8.3% returns with a winning ratio of 73%. Whereas the same number increases to like say 95, 96%. Like if you just simply increase your time frame. So say right from say 6 months to like 3 years, right? Like these are all absolute returns, like without considering dividends. If you look at it, like can you see this graph like going up? And
Yes.
is it a similar trend like across indices, like be it mid cap, small cap? So in fact, if you're trying to invest in small cap, right, it is very essential that like you should have a very long view, like say like more than ideally like 4 years, 5 years kind of a view, because like that is when you'll actually start winning, and you'll at least not lose your capital. So and this is how like we kind of look at it, and this is the number like which we also like look at, say for example, in that rolling window, like what is my average loss like which I can expect. If you look at 3 years, when I said like it is a single digit number, it is about like 4.5%. So typically like Nifty, I mean, it's down 4.5% whenever it makes loss, and there's a 95% chance that like it will end up being positive. So, I mean, can you see that reward to risk game getting played out here? I mean, is it working in your favor? I mean, very simple. Like, you know what is your reward, you know what is your risk, and and you'll have to just increase your time frame to like benefit from this, and that is when you kind of I mean can take advantage of it. Obviously, since we are quant, we are always say interested in like how we are performing relative to the benchmark, and this is how we do say for example, this is not absolute returns, these are relative returns. Say for example, like if Nifty happens to give like say 20% returns next year, we expect our blue chip baskets to hit 30% returns, and this is our probability. So here I know what is my probability, and I know I have an expectation of like how much outperformance like which I can do over the benchmark. And again, our ability to win increases with say time spent in the market. So, and that is the reason why we strongly believe that you should increase your time frame, and like spend enough time in the market and in the strategies, so that like it will work in your favor. So most of the people like have a very short-term view, and when it is down, like say 5-6%, right? Like say in say 3-4 months time, they just exit and they say that stock markets it's not working for us. I mean, because yeah, it is not going to work for you. Like if you operate it that way, like you should have a minimum 1 year, I mean, horizon. That is when like things and numbers will start working for you.
So if I understand this correctly, if you are there in the market for 4 years, there is a 96% probability of you winning in the market, and that will be the same in case of your small cases as well. That if a user is sticks with you for 4 years, there's a definite probability or a very high
Like we will
probability that
outperform the index. So here we are interested in relative performance, because like we'll have to add value for the active management fee the client pays us,
correct.
right? So the only way like we can justify it is like by adding uh, excess returns over the benchmark, and this is our internal metrics like which we look at, and thankfully we were able to do it. If you look at it, see, this is our say uh, b- market category baskets. Like we do have like 6 baskets out there, like serving different market categories, and all 6 are outperforming the benchmark. And today, like if I can go to sleep comfortably, right, like it is because of the confidence like I have on the system, and the kind of numbers like which I know on back of my hand with probability, that like this is what I can expect, and this is the drawdown which I can expect. So I can go to sleep peacefully. And and just to show like other baskets, like say sectors or something. So there's only one sector like where we kind of underperform the benchmark, like which is pharma. Like apart from that, thematic, like we have introduced recently, like 6 months back. But this is how we have been performing, and this is the multi-sector thematic basket which I was talking about. So even if we take say view, right, like we want to do better than the benchmark, and that is how we are able to add value through our AI ML methods.
So Karthik, you have multiple small case portfolios. So if a user wants to select one portfolio, which is the one theme that you are bullish on for the next 1 year or 2 years ahead?
Right now, if you look at it, we are comfortable doing a flexi cap basket of ours, cause you have exposure to top 500 names. I do agree, over the last 1 year, the returns it's slightly below the benchmark, but if you look at a 2 year time frame, right, so it has generated an alpha of 40% over the benchmark, which is what we are
Correct.
comfortable with. And since it's a multi sectorial, multi-thematic, it has everything, all themes, all sectors, it is market cap agnostic. So it has the ability to shift from large cap to small cap to large cap when the market changes. So, and it is very dynamic. So this is something which I would suggest, if you're looking to put large amounts of money in. But if you are looking for, say, pure returns, we do have a lot of say momentum baskets out there, which is designed for pure returns, be it tiny titans, micro cap, or say Chetak. So all these are a pure return kind of a strategy, where we are trying to maximize the returns out there.
Got it. And my last question for you is it possible for a novice investors to learn AI investing? And if he wants to start, where can he begin his journey? For example, he's a
Uh,
new investor, he's 24, 25 years, and he wants to start building his AI knowledge.
I'd like to share a story about my immediate manager in Motilal Oswal. Right? So he was a BCom graduate. He didn't know
Okay,
coding, but he picked it up, and and he was my boss. So I mean, if a BCom graduate can do coding, or for example, when I was working with, say, antique stockbroking, so I had this a CA colleague sitting along with me, and she used to code on MATLAB and Python. So I
okay,
mean, when you have the will, right, to do it, and slowly this is where the markets are moving to. So
correct,
and ultimately, it is your choice either to learn and adapt, or just stick to your methods and then ignore it. So I mean, when you have the intention of, say, doing it right, you'll find a way to learn coding. And coding is not that complicated a subject out there. So the reason why coding is important is that for you to say create AI ML models, your coding skills is the base. So on which you'll further build your say statistical models, AI models, and apart from that, creating system architectures which will do the compute. Because cons is not only about numbers and mathematical models. In fact, 80% of the work that cons do, right, it's on infrastructure piece. How are you going to run these code efficiently, and how are you going to ensure that it is accurate, and then very fast, and how are you going to ensure data integrity? So all these are minor headaches out there which you'll have to say address. So if you don't address it, all kinds of biases kind of creep into your system,
correct.
and that is when I mean, most errors happen. So uh, I would say that just start coding. I mean, there is no right or wrong time. Just start coding, and eventually, you'll pick up. And you will know. If I mean, you cannot do it, you cannot do it. Um, at least give it a try.
Correct. So anyone who is new to markets and wants to start learning, there's always a beginning. And even if a BCom graduate can learn it, definitely other people surely can. So before we round up for the day, Karthik, I would like to thank you for sharing all your insights with us. And if you want to share your final take on the markets and wish people Diwali, you can take it ahead.
Sure. So I do have a discount code for small case participants out there. So So if you intend to subscribe to our small cases, right, like we are offering a 15% discount for that, and you can enjoy access to our AI-based portfolios using this code, and then uh, I mean, make a better investment choice.
There's a question from the customer that can this offer be used by existing customer also to continue your service?
Okay. The thing is, like, you can reach out to us and we'll work out a way by which, like, we can make it accessible to you, like either at renewal or say a new subscription. It depends on at what stage you are and like how we are planning to renew it.
Correct. And there's another question from our users that which is the small case that you are most bullish on. So if I am correct, it is the FlexiCap small case that you have launched.
Uh, okay, so most bullish on, like, I would say tiny titans, so micro cap stocks. That's because the thing is, like, it's very risky, but off late it is doing well for a simple reason that if you look at FI selling, right, like it is mostly in large caps. So that is
Correct.
where most of their ownership is in. Whereas in micro cap stocks, like it is slightly less, even lesser than small cap stocks. So liquidity is an issue in micro cap names, but we do have say volume filters like which we keep while creating these baskets. If you're looking for say like pure returns perspective, tiny titans is something like which you can consider, be it tiny titans, startup India, unicorns, etc. So but obviously like this risk associated with it, like know it before you invest.
Correct. Because even you are focused on reducing the risk in the portfolio, and user before subscribing to any of his small cases should be aware about the risk that is there. So thank you everyone. Thank you for joining us. I hope you have a great Diwali. And for such more interesting insights, conversations, and live webinar, please subscribe to our small case channel. See you soon. Thank you. Bye.
Yeah, thanks, small case, for this wonderful opportunity, and I hope to interact more. Thanks.